Hello and welcome to the special show. MCX Investor Protection Fund presents Demystifying Options and Indices, partnered by ET Now. Investors are increasingly exploring commodities as an asset class, and within the commodity derivatives universe, they're looking at options and indices specifically. So let's find out a little bit more about that. What are the market drivers influencing investors here? And where do the most promising opportunities lie? And what are some of the challenges, some of the hurdles that need to be overcome, some of the risks that people need to be aware of? So today I'm joined by a panel of experts, and we will be looking at this topic from all the angles. Allow me to first up introduce my experts. We have with us Mr. Rishi Nathani. He's the head business development and marketing with the Multi-Commodity Exchange of India. We have Mr. Praveen DG, the head of corporate communications at the Multi-Commodity Exchange of India. Mr. Jigar Pandit, he's a director with Sher Khan. Mr. Ashok Kumar Agrawal, the executive chairman at Globe Capital Market. And we have Mr. Narendra Wadhwa, he's the MD at SKI Capital Services, and he's also the president at CPAI. Gentlemen, thank you so much for taking out time for being here with me today. Mr. Nathani, I'll start with you. Now, when you talk about the Indian commodities market, it's in the midst of a paradigm shift. How do you assess their resilience as an asset class?
Commodities as an asset class has come to the fore, especially now when you've seen so much economic upheavals with the Russia-Ukraine conflict and earlier with COVID-19. So commodities have proved their mettle. And many people brand commodities as an alternate asset class, but I would say it is the most mainstream asset class of all. Actually, if you see, everything around us is commodities. Whatever we are wearing, eating, using, everything is commodities. So I think the commodity markets are in for a paradigm shift in terms of participation, in terms of overall acceptance, and more so as a financialized asset class.
Like you said, yes, it's everywhere around us. So it's always good that now there is more and more investor interest in that. Mr. Praveen, I'll come to you next. A basic question that I want to ask you on behalf of our viewers is, how are commodity indices constructed? Because sometimes people are very confused about that. If you could shed more light on that.
So the calculation is commodity indices are return-based index. That means here they are essentially considered the price returns and the roll returns, whatever is there in the underlying commodities. And then they come out with whatever is the overall returns. That means price returns plus the roll return. Considering these two things, they compute what is going to be the index value of a particular commodity index. That is the very reason they are called as excess return index, because it is a component of, it has components of both price return as well as the roll returns. So another important element that we have to keep it in mind while computing the commodity indices is, unlike in equity indices, which are actually based on the cash market, that means you pick up the scripts from the underlying cash market. Here it is based on underlying futures contracts.
Very important, Mr. Praveen, because it just helps to set the foundation for our conversation and also for viewers who are watching to get some kind of, the basic difference and just the basic understanding. So thank you for that. Mr. Agrawal, let's move a little towards the topic that we are talking about today, which is demystifying options and indices. What are some of the finer nuances of investing in the options and indices segment? What's your take? What's your guidance to our viewers?
The basic difference between index options and index future is, if you buy a index option, let us say you are a farmer and you are growing wheat, you buy a wheat option and you buy a put option at 1200 rupees. So if the price of wheat goes up to 1500 rupees, then you have the option to sell that wheat in the market at 1500 rupees. If the price goes down to 1000 rupees, you have the right to give delivery at 1200 rupees. So, chit bhi meri, pat bhi meri. Of course, you have to pay a premium for that.
Right.
So that is options. So option gives you the right, but not the responsibility. But a future is a firm contract. So either you give delivery or you roll over your position. So somebody, whether you are a individual or a market participant or a hedger or from industry, you can use appropriately the future and options for your purposes.
So I think the good part about this, sir, is that it is suited to different people from different spaces in the larger ecosystem. So you use it as per what it is beneficial to you.
Yeah,
it's flexible in a way, so to say.
Yeah.
We'll talk a little bit more about that, Mr. Pandit. But first, I want to come to you now. Obviously, Sharekhan is a leader in its space. So how are you assessing the evolving retail footprint, the retail participation in options and indices investments, specifically in this space?
We play a very important role in terms of the product awareness program. So when I'm saying product awareness programs, which includes the various type of trainings to the clients, how the products are happening, what are the risk involved, how a retail participant or a HNI or a corporate or a hedger can actually participate in this instrument, including options, how they can hedge their risk. When we do all these activities, which has resulted to a very large participation, increasing in the participation, increase in the interest. So by and large, we see that going ahead, including the options and indices, we will see a little more larger participation from going ahead.
Okay, that's really important and that's really good to know. Mr. Wadhwa, we've spoken about how the market is growing and the future opportunities that they have. But I want to be the devil's advocate with you. Let's talk about the risk factors associated with investing in options and the indices space, because that's really important. What's your advice to our viewers?
So my advice would be, say, products are available and one must take some exposure in the commodities market. As I'll give you one of the reference point that in one of the studies says by the PwC, say we'll be at 2.5 trillion economy. We are saving around 20 lakh crore per year as a household saving. With 5 trillion coming in, we'll be saving around 40 lakh crore worth of household saving. And they will be taking exposure in the commodities market. So as an intermediary and participant in the market, I just caution them that they have to take part in the commodities market, but with the caution.
Very true, Mr. Wadhwa. That's really important. And I feel that, already MCX IPF is doing so much. All of you in your roles, even us as this channel, we are trying to educate. So the important thing is people should not just be in a hurry to get in just for the sake of doing it. Learn it, research it, see how things evolve and then get into it. So, Mr. Nathani, if you could come in with what you wanted to say. And also, my next question, I'll throw it into you together only, just about being a good hedge against inflation. That's also really important. And I think Mr. Agarwal was also alluding to that. So, Mr. Nathani, if you could come in on both these points.
Sure. So thanks, Sumit. Just to add to what Mr. Wadhwa was saying, if risk is managed well, it gives you great returns. So the point being that there are various instruments for various levels of risk. So one man's meat is another man's poison. So it is up to one's understanding. So I would always say investigate, then invest. So it is up to one's understanding and need. So for a hedger, he may need to sell a future. For a first-time investor, he may need to just take delivery of small lots or buy an option and limit his downside by paying a premium. For a seasoned trader or investor or speculator, they can do more risky bets like writing options. There is no good or bad. It is all depending on one's understanding and risk-taking capability. Now, coming to the point of commodities being an inflation hedge. Actually, that's a great point because now we are seeing globally there's a lot of inflation happening and commodities are doing well. What is inflation? It is rising prices of goods and services, and commodities is part of that goods. And you'll see that commodities are counter-cyclical to equities and bonds in the long run. So that is the reason why one should have commodities in their portfolio, because when there is inflation, commodities will always do well and give diversification to the portfolio as well as reduce the risk in the portfolio. Another thing is that commodities give you an inbuilt forex hedge, especially for internationally referenced commodities like gold. If the gold price internationally stays same, but if the rupee depreciates against the dollar, you will see that the domestic price of gold will go up. So you get an inbuilt free inflation hedge also. So in that sense, it makes all sense to invest in commodities to protect yourself during uncertain times.
Mr. Praveen, can you talk to me a little bit about the index futures contracts? I wanted to know what are some of the main features of the same.
See, one thing what I can say is these are very simple products which anybody can understand and they can able to trade. And the biggest benefit of all in this one is it is a cash settled product. That means no delivery challenges. There is no delivery related margins. So nothing like what you typically pay towards the tender period margin or development margins. All these things are not applicable in case of index product. Today, most of our products, commodity products, are all compulsory delivery products. In the means, essentially, whenever you hold it till the expiry, that will result in the delivery of that particular commodity. But in index, it is like this being a cash settled product, it gives the comfort for everyone who is really averse to the delivery. Second, another part I can say is this is like all-in-one contracts. That means you have everything in one. That means you have multiple commodities in one basket, and that basket is getting traded. That way, you are greatly reducing your risk element in your portfolio. So you can use it for benchmarking purpose, or you can use the same index for the portfolio diversification, wherein you can able to optimize your risk return profile. So that is how this will be beneficial. And another part that we have to look at it is some of the products, some of the commodity contracts are of longer duration contracts, maybe the bi-monthly contracts and other things. But these are of all monthly contracts. That means you have a shorter duration contracts are available in this case. And finally, in short terms, we can say that it is a derivative of derivatives. This is what we have to keep it, but the products are simple to be traded.
I think one of the most important points I would like to take from that is the point of diversification, because diversification is really important. Mr. Agarwal, I'll come to you just one step ahead of diversification. And I know people must be asking you this all the time, that how much of my portfolio should I be investing in different asset classes, or specifically how much should I be investing in options and indices in the futures? How do you give them? Because there is not one right answer at all. So what is your guidance there?
How much you should invest will depend on each profile. So if you are a actual user, then it will depend on your, let us say you are a raw material user, you will buy the raw material. If you are a individual who want to marry off his daughter, then maybe the gold that you want to give to your daughter in marriage, you can buy as a option or as a future, and you can accumulate it also. So that will depend on individual profile. But let us say a ballpark figure, 5 to 10% of your wealth should be invested in commodities. But ultimately, you have to take an individual call.
Absolutely. The important point is to each his or her own. We have to customize it, and we are getting the good facility here to customize it. Yeah. Mr. Pandit, earlier you were talking about how people are, customers are showing interest in this space. Mr. Wadhwa was also saying that more and more millennials are coming in. So I'm definitely sure technology has had a very strong role to play in this space, just making it easy, democratizing trading activity in the options and in the commodity space. Just wanting to get your viewpoint on that, sir.
So Sumit, as I earlier also said that we being an intermediary plays a very, very vital role in terms of, developing the industry, the product. So is the case with the technology also. So we invest very heavy on technology, yes. Which includes training in terms of how to trade, what are the tools that you can use for trading, what are the tools which help you in making decisions, especially when you are trading in the options or in the indices, because we have seen the recent volatility has also played a vital role, important role, because the futures has a very heavy risk versus a client who is trading in the options. The relative risk is relatively low. Same is the case with the indices also. Clients are, the risk is spread out, So suppose a client wants to trade in options, we give them a tools like how to see the Greek of the options, the charting patterns, even the stop loss orders, or some sort of a semi-algo, all those systems are playing very important role,
Absolutely. I think so. Both points, like how you said it, as an intermediary, also helping educate and make the customers aware. I know that technology is playing a very important role there also, and obviously just helping them to take those first steps into this on this journey. Mr. Wadhwa, we were earlier in the conversation talking about hedgers also and how they can use options and futures. Just if you could shed more light on that, how physical market hedgers can benefit from options and futures.
When these commodity exchanges were built in 2004, 18 years back, the very purpose of this creation of commodity exchanges is that there will be authentic price discovery and there will be efficient price risk management. So they can choose the indices, which is a mixture of various commodities. They can use option, which is the cheaper version of taking part in the commodities market and hedging themselves. So the cost of transaction is a major part for hedging, and we have to ensure that their cost of hedging is low. Many importers, many manufacturers are using these indices and options and underlying of the MCX. And what we have to do, as Jigar was just mentioning, only thing is that there should be awareness of it. So we are doing many programs and to educate the real user, hedgers and importers, so that they can use the instruments traded on the exchanges for their hedging part.
That's a very important thing that you mentioned, Mr. Wadhwa, because this is what is so much required, this education, this making people aware, showing them and guiding them so that, they can start off on this in the correct manner, rather than, just like we said earlier, just open an account and start. And that's where people fall, make mistakes and make losses. Mr. Nathani, for taking what Mr. Wadhwa said ahead, how are options beneficial in lowering risk?
Here, what happens is that your downside is protected, but your upside is unlimited. So what happens is, if you pay a premium, and suppose there's a commodity priced at 100, now if I buy a call option, and if the price falls to whatever, below 100, I don't have to bear that loss. But if it goes above 100, whatever it goes up to, I will always get that benefit. Similarly, if I buy a put option and the price goes down, I will benefit. But if the price goes up, I will not have to bear the losses. So I can play either side of the market by paying a small premium and getting the maximum benefit. So in terms of chances of maximization of my profits, options are a great way to access the market.
Absolutely. And like you said, with a little investment, so to say, as a little premium, you get a huge sea of possibility of making profit. So your risk is limited, your profit is unlimited, which is what everybody wants. And I think Mr. Agarwal has also said earlier, ki chit bhi apni aur pat bhi apni. So that is what we all want. Mr. Wadhwa, last question to you, sir, on the panel as we wrap up. So you're also the president of the CPAI, or the Commodity Participants Association of India. As a broker industry body, what is your outlook in terms of options and futures as a growing segment, as well as attracting more participation in the commodity derivatives market as a whole, sir?
As a brokers body, CPI is closely working with exchanges, regulators, SEBI and Ministry of Finance for the development of the market. So world over, the volumes in commodities markets are multifold of equity market. So we see huge scope in these markets. So for development of market, 3 Ps are required: policy, product and participants. So most of the things are in place. We have all kind of products on the exchanges, like options and indices. Participants are also there. FPI are also going to come in addition to FPI's mutual fund. So it is our endeavor to increase the depth of the market and increase the market. And we are closely working with all these stakeholders. And let's hope, I think there is a huge scope. One data point, again, I'll say, for 5 trillion economy, 40% will come from the commodity sphere. So we have to ensure that this commodity sphere is quite robust and conducive for all the participants.
Absolutely. Thank you so much for that, Mr. Wadhwa. thank you again for coming on this panel, because together we are trying to educate our viewers about the benefits along with some of the risks, because I think it's always important to put both sides of the coin to the viewer. So that's all the time that we have. Thank you, Mr. Nathani. Thank you, Mr. Praveen. Thank you, Mr. Agarwal. Thank you, Mr. Pandit. And thank you, Mr. Wadhwa, for coming here and talking to me about this important topic. To our viewers, you've been watching a special feature, MCX Investor Protection Fund presents Demystifying Options and Indices, partnered by ET Now. And I hope you're taking back some very valuable insights from our session today. Thank you so much for watching.